So the big story last week was October CPI. It showed an increase of 6.3% versus 6.6% the prior month in core CPI. What's critical to note, though, is that more than half of that drop can be attributed to a quirk in how health insurance costs factor into the CPI. Now, remember, the Fed looks at PCE prices more so than CPI. And PCE doesn't have that same health insurance calculation, and it also weights used autos less. We all know what's been happening to the used auto market, prices decreasing rather fast. The PCE uses a weighting of 1.7, whereas core CPI uses 4.9. So it's way too early to declare victory on inflation. Inflation's a process. It doesn't just stop on a dime. I think the market's reaction to October CPI was way overdone. At the time the number came out, 10-year yields were at 4.1%. We walked out the door on Thursday at a 381. That's almost a 30 basis point drop on a 3/10 beat. Way overdone in my opinion. I would expect the market to give back a healthy amount of this move this week and next. When Powell spoke after the September FOMC meeting, I made a comment that he was offering more clarity and stability to the market by providing a little clearer outlook on his decision making. Clarity is exactly what corporate treasurers need when they're deciding whether or not to tap the capital markets. Given this drop in rates, I would expect a healthy amount of corporate issuance to start to emerge. Even the announcement of the deals alone and the pre-hedging related to those deals will be enough to push 10-year yields back up to the 4% and probably through. The overall credit picture globally seems to have improved. We say that because last week we saw over $100 billion in new corporate issuance just between Europe and US. Credit spreads, particularly in Asia, enjoyed their best week since the onset of the pandemic. Again, that comes down to the clarity that the Fed provided. I expect liquidity to start to dry up or get worse as we head into next week in the holiday season. So if I'm a corporate issuer right now and I'm on the phone with my investment banker, I'm deciding to come to market rather soon. We're just looking for one announcement from a large corporate issuer, and we could see a rather dramatic reversal in rates. Equities are a different story. Equities are driven by different flows. But in the rates market, the reaction on Thursday tells us more about how the market was positioned than any macroeconomic outlook. I'm sticking with the call made back in September that the Fed is going to do 50 basis points in December and then reconsider, most likely, a series of 25 basis point increments thereafter. I do not see them going 75 at this next meeting. So in closing, I would expect a lot of this move to be reversed in treasuries. Look for us to push through 4% again. I'm looking for a steepening of the 2s, 10s yield curve, and I'm looking for liquidity to start to dry up after this week, which again tells me that you're going to see a plethora of new corporate deals coming to market. Oracle last week came with a $20 billion deal. Had they waited 2 days, they would have saved themselves an estimated, $960 million in financing costs. So those are the main drivers I see for this week. I'll check back with you at the end of this week to give you a little summary, and that's what we're looking for. Thanks.